Hello to those of you who are purchasing a home or maybe refinancing one, and you're trying to decide whether or not it makes sense for you to get a variable or adjustable rate mortgage or a fixed rate mortgage. And so it's going to be a very short video here, so if this what I'm going to tell you is helpful, please give me that thumbs up. The reason why most people get a variable or an adjustable rate mortgage is because they can get a bit of a lower interest rate, which also lowers their payment. And that's really the primary reason, because each of these adjustable rate mortgages are only adjustable for a short period of time and then they get locked in. Plus, usually they adjust each year, and you've got that risk factor of it potentially going up even higher than where a fixed rate mortgage is today. But you're trying to get into this house, or you're trying to immediately lower your payments, maybe because you've got maybe a cash flow issue. So while an adjustable rate mortgage in the past was a huge thing for homeowners or future homeowners to go after, at that time the difference between the fixed rate mortgage rate and the adjustable rate mortgage rate, the spread seemed to have been a little bit wider years ago. I'm going back years, okay? But what I would recommend you do instead, if you're looking for an adjustable rate mortgage simply to lower your interest rate or your payments, is instead negotiate. If you're buying a house, negotiate with the seller to have the seller cover your cost to buy the rate down with points. You could probably buy that rate down at the same level or interest rate of an adjustable rate mortgage, or even lower, by paying points. And then you've got the stabilization of having a fixed rate mortgage for 30 years without it having to adjust every single year for the first 5 years, for example. Okay, so that's what I would do if you're buying a house. Rather than go with an adjustable rate, see what that adjustable rate would be if you went with the adjustable, and then ask your loan officer to say, okay, what would it cost for me to buy down a 30-year fixed rate down to that interest rate? And then that would lower your payment to be the same. And if you're looking to refinance, then just ask your loan officer for what the rate buy down would be. You know, how much would it cost? And then you could either bring that money to the table at closing, or you could roll those costs into your loan to buy it down. That would be my recommendation. At this point, I really don't see, based on the two options I gave you and the scenarios, I don't see the need to get a fixed rate. I'm sure there's a loan officer out there that's going to remind me of something that I'm not mentioning here. It's been a while since I've dealt with adjustable rate mortgages, so that's what I would do. And if you want a quote, you want to talk about it further, and you want to have someone give you the two scenarios side by side and see what it looks like, then definitely reach out to dreamhomefinancing.com. We'll help you there. Same day service to at least answer your questions. So again, hit that thumbs up for me if this was helpful. I do appreciate you all, and I hope you have a great day.